Welcome back to the Microlearning Institute. In this tutorial we look at CEF from the May 2013 AIA Paper 13 exam. Here we're asked to calculate the amount to be included in the entity's statement of financial position to reflect a dismantling operation that must happen 10 years after the question is set. So we're given a variety of different data that help us to compare and prepare the fair value of this likely obligation. Firstly, we're told that the labour costs, that there's a 30% chance that the labour cost required for this dismantling operation would be 20 million. There's a 40% chance that the labour cost will be 25 million, and again there's a 30% chance that it could be 35 million. So overall, the expected value of the labour cost in 10 years' time is estimated at $26.5 million. Next, we're told that industry best practice is to allocate overheads and plant operating costs at 90% of the expected labour cost. So overhead at 90% on top is added to at 23.9, giving us a fair value to date in our calculation of 50.4. Next up, we're told that the profit markup that a third-party contractor would typically require for undertaking this dismantling and assuming the risks is 20%. So the markup is an additional 20% of the 50.4 million, which is 10.08, updating our fair value calculation to date to 60.48. The next thing we're told about is inflation. And we're told that based on market and economic forecasts, the rate of inflation is estimated at 4.5% over the 10-year period. And the inflation factor to reflect this is 1.533. So again, multiplying the 1.533 by 60.48, we update our fair value calculation now to 93.93. Also, we're told that the compensation that a contractor would typically require for the risk and that actual cash flows may differ from those expected is 5% of the cash flows after inflation. So again, 5% of the cash flows after inflation is an additional 4.7, giving us a fair value now of 98.63. Now, this fair value of the liability is going to occur in 10 years from the date that the exam question is set. So therefore, we need to discount this fair value of the liability at the market rate. And the market rate is made up of the risk-free rate of 6% plus the estimated rate of 3% to reflect CEF's own credit risk. So 6% plus 3% is 9%, and 9% discounted over 10 years results in a discount factor of 0.422. So when we discount 98.63 by 0.422, the present fair value of the upcoming liability is recognized at 41.62. Thank you very much for watching this short tutorial from the Microlearning Institute about CEF from the May 2013 AIA Paper 13 sitting.